Hello and welcome to the Fibonacci free video for Friday, October 21st. This is David, and hey, we're starting by looking at the S&P 500 from back in this decline from the 2007 high to the 2009 low. And there are a few things I want to talk about here. The first is when we have these really big moves, right? These moves where the the index is basically cut in third, right? And also when you have moves up that are where the move up takes prices to several multiples of where they were at the origin of the move. A lot of times it can be better to view these moves on a log scale. And when doing Fibonacci work on these very long moves, it can also be useful to do the Fibonacci work at log scale. Right, so you'll see here, right at the bottom end of the scale, we have these moves that are about 50 points apart, and it's pretty wide, right? And then up at the upper end, we get these moves that are about $50 apart, and they're much closer together. And by having the scale adjust all the way along, what it ends up doing is it creates a situation where moves of the same percentage end up, right, traveling the same vertical distance. That's distinct from when we switch things back from log scale to arithmetic scale, where moves of the same point value will move the same vertical distance on the chart. Now, calculating a Fibonacci retracement on an arithmetic chart, and we can switch this back to arithmetic really quickly, right? If you were to calculate it by hand, it would be pretty simple, right? You would simply take the high of the move and the low of the move and subtract the two to figure out the total move. If you wanted to figure out the 61.8% retracement, right, you would multiply that total move by 0.618, and that would be the value of the rise, and you would add it to this low to figure out what the 61.8% retracement level was. Now, to do that in log scale is a little bit different, and many platforms don't do this, right? But if you wanted to calculate the 61.8% retrace in log space, what you would do, right, is you would take the logarithm of this high and the logarithm of this low. You'd subtract them from each other, right, to find the difference in the log space. Then you would multiply that difference by 0.618. You would add it to the log of this low, and then you take the inverse logarithm to get something back, right, that had an S&P price value. It's a more complex calculation, and this platform, MotiveWave, if I switch over to a log scale chart, will calculate that that Fibonacci proportion differently. So you'll see right here, right now, it's the 61.8 retrace is $14.54.19, and if I switch back over to a log scale, you'll see that it is 14.45.60. So about a 9-point difference here by calculating it this way. A lot of other platforms that I've used will simply show the arithmetically calculated one even when your chart is in log scale. One that I know that anybody can use, TradingView, right? That will behave the same way as MotiveWave here. And it is, so if you do want to play around with calculating Fibonacci retracements in log space, that's one that will do it. And I find that to also be effective for these rather large moves. And when we do things that way, for this initial leg down from from the 2007 high to the end of the first leg to the downside, and then look at this first retracement. That first retracement is just about 61.8% when we do it here in log space. So I want you to keep that in your mind, right? And then let's also look quickly at this move down here, the next little leg, not all of this third wave down, but just this small degree wave 1 and this small degree wave 2. That small degree wave 2, again, calculated in log space, retraced 50% of just leg to the downside. And the reason I mention that is that if the S&P 500 is going to be following a similar path where we've got 1, 2, 3, 4, 5, which would send us much lower from where we are now. Right now, this is by no means a certain thing, but it is definitely a possibility with how things are unfolding. Well, in that scenario, right, we'd have a wave 1 down, a wave 2 up, and a wave 3 down. But that wave 3, like all waves, like this wave 1 also, will have its one smaller degree 1, 2, 3, 4, 5 within it. And if we're following this script, then the place we likely are is in this bounce right in here right now. All right. So if we go and look at what the real-time current price analog of this would be, right? We'd have this larger degree 5-wave move down, right? This would match that first move down that we saw on the other chart, the larger one, and the retrace in log space, because this chart is on log scale also, back to 61.8. So we're matching that piece. Then we get another leg down, and this would be the smaller one, just the start of that larger degree third wave down, and if that's what was going on, and if we also get the same retrace here, 50% in log space, then that would be to roughly 38.86. So maybe if we're following this script, we retrace to about 38.86 or so, and then roll over. So again, it doesn't have to go exactly that way, and I don't yet know for sure that we are in this scenario, but this is something to watch, and that is an area I want to watch along with 3,900 roughly, which is a little bit above it. The other thing that I want to look at, right, if we go back and take a look at that move from 2007 to 2009, if we look at timing here, right, and just measure from what was at the time the all-time high, well above that, right, to the end of this first bounce. So swing high to swing high, that was 151 days, 151 bars on the daily chart, right? And then if we looked at the move from that second high, right, just again down and up, swing high to swing high, this one was 58 bars. So if we swing back around to look at charts in current time, what we can see is that same move, swing high, right, or all-time high, to swing high for after the first move down and move back up, 154 bars, very close to the 151 bars that we saw on the previous chart. And right, if we then measure from here 58 bars in the future, that takes us to November 7th. So so if this is going to continue to be an analog, then maybe up towards 3,900, roughly November 7th. We want to keep watching the patterns. We want to keep doing our fib work on the swings inside this move up to see if they correspond to that level, and if they're shorter term signals that correspond with it. But if they do, then and they identify the likelihood of a swing high, then we want to see how far that has the potential to go. If we are, if 2007 to 2009 is an analog to what we're seeing now, then that may be a spot to really focus on. So so that's what I'm going to be watching here over the coming days and weeks, and thought I would share that with you, as well as sort of some of the importance of, for longer moves, using those Fibonacci proportions in log space. I hope you found it useful, and I will see you at the next update. Hey, David here with Simpler Trading. Thanks for taking a few minutes to watch this video. I hope you found it useful. And if you did, please help us out. Click the like button. You can also add your comments below. We love to read those and respond to them. You can also click the bell icon. That will alert you whenever we have new and updated videos. And if you want to watch us trade in real time with our own money, you can visit simplertrading.com to learn how to sign up. Until I see you again, as always, good trading, and we'll see you at the next video.